in the last 6 months, the market has had a menu of reasons that would justify either a correction, huge correction, or even a crash. That's right. One of the worst situations is breadth, market breadth. So important to a market, because when you have more stocks where the prices are going down, in other words, take the S&P 500 stocks, and you take those 500 stocks and you have more stocks out of those 500 going down, say 465, that's a downtrend, and underneath the 50-day moving average, and you only have 46 of the 500 stocks above the support of the 50-day moving average and prices going up, that's considered bad breadth. Very bad. The last time we've seen that was back in 1999, right before the dot-com crash. And then what was interesting, last week was a terrible week. We had all kinds of bad economic numbers. We had jobless claims are up. We had housing starts. Horrible. Manufacturing. We just got the Philly Fed numbers in, and the wheels are coming off manufacturing. That's just one sector. Last time, all four were down, and no reason to believe that it's not all four are going to be down again. In spite of all that, yields were up, not down. See, normally when you get bad numbers like that, yields go down, because when you have bad news, everyone expects the Fed is going to cut rate. But that didn't happen. We got all that bad news. Yields, when the dollar went up, and that's really unusual. So take a look at, to put the rally in perspective, take a look at this chart right here. There's stages in a market rally. And if you look at this stage here from 1 to 3, we are now at peak. And that is the most dangerous area right there, stage 3, because this is where euphoria sets in. Stage 3 is where there's hope, optimism, complacency. And that's when people start believing that the money they made on the way to stage 3, they equate that profit to their intelligence level. And they think they're geniuses. And they start making up reasons why the market will never come down again. But it will. But that is a dangerous stage right there. And when you get between stage 3 and stage 4, this area here, that's where all of a sudden you get denial. That's the denial stage. Oh, my stock will go back up. My stock's going to go back up. And even when a stock drops, let's say 35%, they truly believe the stock's going to go back up 54% to break them even. Or if a stock dropped even 40%, not worried. My stock's going to go, I got a great stock. It's a great company. It's going to rally another 67% so I can break even. So we're now in stage 3. We're soon to enter between stage 3 and 4, where it really gets dangerous, where there's denial, and they don't, and investors don't protect themselves. They don't even want to hear about taking profits. They don't even want to hear about a market could crash. Oh, they don't want to hear that at all. They don't want to prepare for it. They don't want to even learn how to sell short. This is why, again, 80% of the people in the stock market lose money. Now, last week, with all this bad news, everyone said, it's okay. Don't worry about it, because the market's not going to come down. It's going to keep rallying. You know why? Because we're in the middle of this AI craze, where you have the chip stocks, Broadcom, Taiwan Semi, Micron Technology, they're the leaders, selling their chips to the cloud companies, Apple, Microsoft, Meta. Now, all of this, again, is led by NVIDIA. It's gotten so bad that those stocks that's driving the whole S&P, remember, those stocks, which, by the way, NVIDIA is up. They hit last week $140 a share. That puts them up about 200%. That's leading the S&P. And if it wasn't for that, the NVIDIA and those tech stocks, the S&P would never be up where it is today. So they're dependent on these handful of stocks. So the danger comes, is it more dangerous to stay in these rallies, or is it more dangerous to get out of these tech rallies and lose all these profits? Well, you don't have to get out, because you can protect yourself if you want to learn how to sell short, and if you want to learn those messages from the market that tell you, hey, the market is about ready to crash. And one of those messages, of course, is the utility stocks. They always work. When utility stocks go up, and they don't have to be up as high as the S&P, just follow behind it. Every time, it's always been correct, saying, hey, we're going to get a correction or we're going to get a crash. Take in 2018 to the end, 2018, 2019, where we had about a 20% correction. Right before that correction, we had the utility stocks going up. And then, right before the pandemic, my subscribers, not only did we short that little bit of a pullback that we had was about 20%. That was about the end of December, I think it was, 2000 and, if I remember, 16 or 17. But when we got towards the pandemic, it was clear the utility stocks on the chart was going up. So we got prepared, took our profits, and started to short. Thank God we did. Bam, the market went down. So you can protect yourself. So yes, at times when you know the market is upside down, when you know only a handful of stocks are carrying the whole stock market, we got such a bad breath, the end result is going to be terrible. But nobody wants to talk about that. That's the last thing they want. Everybody's in such denial, as I showed you, especially when they get between stage 3 and stage 4. The denial is terrible. They don't want to talk about that. And even though the economy, is not the stock market, we have right now the total credit card debt in this country is over $1 trillion. And half of the people that have credit card debt can't meet their minimum payment. And the delinquencies are no longer the Main Street household. People make a combination of, let's say, $55,000 to $65,000 a year. It's spread across all tax categories, even the wealthy. That's right. So we have such a bad situation right now with the credit card. And then don't forget, not only the credit card situation, we also have a report last week that came in telling us from Northwestern Mutual that 70% of Americans cannot retire. They can't retire. They won't have enough money. Isn't that awful? 70%. So the stock market is not the economy. The economy is not the stock market. We understand that. But when you have a bad economy, earnings will be hurt. Earnings used to be everything. Earnings. But today, no more. See, we replaced earnings today with this excitement of AI technology. So the banking sector, which is the most important sector, everyone forgets that the regional banks have gotten squashed like an ant. But now it's the big banks that are in big trouble. So the bottom line is this. You got to be open to the fact, that there's a possibility of a crash. If you just block that out and you don't want to hear it and you want to be myopic and I don't want to hear about it, I'm just going to keep buying. If you know how to sell short, if you know how to identify when a market's going to correct before it corrects, and then use those skills to short when it does happen, then you can take somewhat of a risk. But if you don't have those skills to short, and you don't have the skills to identify in advance when these markets are starting to fall apart, then you could lose a lot of money. So I've been doing this now for teaching for over 25 years, been in the stock market for over 50 years, and I've been helping people just like yourself, and I'm willing to help you. And if you have some interest in more information like this, what stocks you should be in, stocks you shouldn't be in, just click the link in my bio. I'll be happy to help you. But for heaven's sakes, stop getting angry at people that are telling you there's going to be a crash. Crash has been delayed. Why? Because of these 10 stocks, 5 chip makers, and 5 cloud companies that buy those chips. This little tiny nucleus keeping everything afloat. We're not that lucky. Well, hope you enjoyed this. I'll see you on the chart.